Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
That's right. And last week, we had our most recent Fed cut, Judson. We have jobs numbers today, fresh, hot off the press. So we thought it would be good, listeners, to go back over what happened in 25, maybe a little prognostication for 26, especially with Trump replacing the Fed chair.
Sounds like we got a lot to talk about. I say we just jump right into it.
Let's go. Okay, so we are going to timestamp ourselves December 16th as we head into the holidays here.
Year of our Lord 2025.
That's right. We had Fed cut on the 10th last week. Jobs numbers this morning. We've got CPI on Thursday. So all kinds of fun things. It is definitely time to get to it.
And we've kind of had a little break between the last jobs and CPI report, right?
Yeah, we have. There's just no good data when the government shut down, right? So we finally are getting a little bit more data, which as we go over sort of the summary here, you're going to hear listeners and some of this language from Jay Powell too late. You're going to hear some language that's sort of like, we kind of know what's going on, but we don't have complete data. So it certainly is fascinating, but I don't know that we got this. This is not a shocking result either, Judson.
No.
It's exactly what Polymarket said was going to happen.
Good job, Polly. Where are we going to start?
What if it really was named after like Polly?
Polly, no, that's her name.
No, because they have one L.
You can have you're named.
You know what?
These days, some of these names.
Yeah, these days there's like 8 spellings of Kagan.
Yeah, it's like P-O-L-I apostrophe.
Yeah. It's like that good Key and Peele skit. Okay, moving on. If you haven't heard the Key and Peele skit, you need to go watch it. It's great.
We have. I had lunch with Aaron today.
That's good. Balake will be on next. Okay, we are going. Let me give a little summary here. Again, cut was last week. Fed cut came in at 25 basis points. So the third rate cut of 2025. We, Judson, are now at the lowest Fed funds rate we've been since November of 22.
That's right. And there was a little bit more dissension this time than over the past couple, right?
That's right.
And not even dissension in the same way.
That's right. Yeah. We had 3 dissent. Austin Goolsbee. Okay. Speaking of Polly, Austin Goolsbee, I'm just saying this, is spelled Austan. What was wrong with his parents? I'm assuming it's a him. It could probably be a girl.
Goolsbee.
Austin Goolsbee.
He goes by Goolsbee.
And Jeffrey Schmid voted to not cut. And then Stephen Mirren voted in favor of a half a basis point cut. So, yeah, we are getting the most dissension for sure, which we'll get to maybe some of the reasons on that here in a second. So, to give you a little bit of quotes, Powell said, quote, conditions in the labor market are cooling and inflation remains, quote, somewhat elevated. Again, that's their dual mandate, both jobs and inflation.
Cool and elevated.
This cool and elevated is another way just to say stagflation, by the way, which we've been talking about all year. So our listeners should know about the unicorn stagflation, right? They also decided they're going to begin purchasing U.S. Treasury bills December 12th, which was a few days ago. They're going to buy $40 billion, Judson, with a B, in 30 days. Again, some dissensions, which we'll talk about. And most importantly, they seem to indicate that rate cuts may be done for now. So that is fascinating, which we're going to get to our thoughts on 26 a little bit. But let's get to that dissension, Judson, because we've got a new Fed chair coming, right? When's that?
May of 2026.
That's right. Yeah, in May. And Trump is already out there. A couple names, Warsh Hassett. It seems to be moving in the Warsh direction here. Both policy advisors, former Fed Gov chair or Fed chairman Warsh as well. So
I don't know. I'm voting for Austan Goolsbee.
Mm-hmm. Austan. Make sure you say it that way. And I think there's an element to this dissension that both I think could say, hey, we're starting to split. This is the most dissension we've seen, but also like we're going to have a new leader in 5 months. And so we're maybe a little bit more convicted to say what we think when it comes to dissension. So certainly indicative that I think that largely folks are getting to a spot where, hey, we're not sure that we're all in alignment here. And I think a lot of that came through. Again, I gave you that language that Powell said when he said, Conditions in the labor market are cooling and inflation remains somewhat elevated, which jobs dropped this morning, Judson. And we see in November, the U.S. economy added 64,000 jobs. Expectations were 50. Unemployment is at 4.6. Expectations were 4.5. So it really is a peak unemployment number here, but it is definitely, to his point, cooling. That's the data they're seeing now.
Yep. Yeah, and I mean, again, you see in that dissension, obviously, just to remind folks on here is that if for the two that were saying no rate cut, they're worried about the inflation side of things most likely, and on the side of wanting a 50 basis point rate cut, they want to spur on the economy and consumerism, and are not worried necessarily about inflation as much.
Yeah, I mean, I think this is actually what stagflation creates, right? I mean, it creates this like we're stuck, to your point. I mean, the reality is that I think Trump is pushing. In fact, he came out post cut. He is pushing or calling for 1% or lower rates in 2026. Would be staggering, and we'll get to some of the poly market, signs on what people think 26 is going to bring, but that would be a huge drop from where we are today. And I don't see it happening. I think that's the classic Trump ploy, which is, get something out there that is super strongly worded and then hope for something different. But I mean, the bottom line is that he certainly sees that, things need to move in a direction in his opinion. And Jay Powell's not seeing that, nor several of the other chair people.
Well, he wants to speed up the economy.
Yeah, for sure.
Bottom line.
So, I mean, look, I think it's a good time to go to 26. So the Fed, in their languaging, seemed to signal one cut in 2026. So I just did a little bit of, digging around before we jumped on. The market itself is actually pricing in two cuts, with April viewed as the earliest possible timing for the first cut. So I think we've probably seen certainly the last one until the end of Q1, based on the market, at least pricing that in. And I think that is, from our perspective, something we've got to pay attention to, because if something dramatic happened in the economic data ahead of that, April meeting, then there could be something earlier, but April appears to be the most likely outcome there.
Well, and you've got, I think one of the big questions out there is, will the new Fed chairman, who's appointed, feel a little bit more like the president and want to push rates, right? And I think that, it has not necessarily been a shared opinion with Powell and the president on how quickly rates should go. And so, I mean, I do think, again, maybe one before the change, and then, will the new Fed chair bring in a new philosophy?
Yeah, and I would imagine so, right? I mean, I think that's where you're starting to get some of the dissension with the current folks, because they're finally able to say, hey, this is what I believe, and maybe align themselves with that oncoming chair. So another interesting thing is I just went straight to Polymarket, and you've basically got between one cut and five cuts, you essentially have 80% of money going right now. So 12
broad range.
Yeah, for sure. 12% are saying one cut, 19% two cuts. The sweet spot seems to be three cuts at 22, which that would be 75 basis points off the current 3.5, which gets us down into the 2.75, maybe 2.5, which is nowhere near his one.
Right.
15% are at the 100 basis points, and then staggering 10% of money is going to 125 basis points right now.
Well, and I think if you're betting towards that 3 to 5 range, you're probably betting that, again, the new Fed chairman is going to agree with what the administration is desiring.
Yeah, for
Gotta
sure.
be.
Well, folks, we'll see. Obviously, what 26 brings as far as cuts go. Now, the market's got some of that priced in, and I thought, we could finish up, Judson, sort of just talking about a little bit what's gone on, and we'll do a full market recap with folks, or with Brad Sanders. We'll bring him on, and we'll do a full market recap episode as usual. That being said, it is interesting to kind of look into where things are now. because the last 2-3 months, as the Fed has started to cut, we have seen some rotation occur in the market. And that might signal us a little bit toward what we can anticipate in 26.
Hunter, what do you mean by rotation in the market?
Yeah, so that's a great question. I mean, you've got all these sectors. When you take the market and you actually break it down, which we'll talk here in a second, the concentration right now in the large cap space. But when you actually break down the market, you do have large cap, mid cap, small cap, and we've talked about that on here, right? And so typically really where we've been for the last 3 to 4 years, we've been in a situation where a majority of the market cap is flowing into large cap stocks. And that's why we've seen these Mag 7 numbers move higher, which I've got some staggering numbers to come on that here in just a second. Well, because rate cuts, as we've talked on the podcast before, because rate cuts, lower rates tend to favor small cap companies. When we started to see these rate cuts occur, we've actually seen money moving toward small cap stocks. And we can see that because you can just look at the index. And so I'll just rip off some numbers here.
You're about to talk about this, but when you see money moving towards a market segment, what that typically means is what Hunter's about to say.
Yeah,
they move higher.
Exactly. Yeah, you're exactly right. I mean, that's the easiest way to see where money is going and where flows, because people are betting with their money on what sector is going to outperform, right? So let's just do like maybe a 1 month number. So over the last month, the S&P is up about 0.8%. The Dow is up about 2%. The Qs are up 0.6%. Small caps, 5%.
Woohoo!
So you've got most of the large cap indices are up 0.6 to 0.8, and small caps are up 5.5% in the last month. So I think that's a huge move. Now, granted, in the grand scheme of things, they're still way under where large cap have performed, but that rotation that's begun to occur over the last 1, 2, 3 months, and you started to see that movement. If rate cuts continue, the economy is heading the direction that Trump wants to, that probably persists.
Yep.
So some staggering numbers that I pulled as I was looking through this. So currently the Mag 7, which we've obviously talked about at length, and when we do a full market recap of the year, we'll go into it. But currently the Mag 7 represents 35% of the market cap of the S&P 500.
Yep.
Which basically is like there's no better way to say it's like the fair market value of the S&P 500. So folks, if you can imagine a neighborhood of 500 homes, and if 7 of those homes represented over a third of the total collective value of homes in that neighborhood, that's essentially the Mag 7, right? I mean, that's the best example I can give toward it.
Great example.
So they represent 35%, which we've talked at length. Now, here's the staggering one to me. They only represent 26% of the earnings of the S&P. So 35% of the value, but only 26% of the earnings, which take you the 26 by itself. That's
huge.
Bananas.
Huge.
Over a quarter of the 500 stocks, over a quarter of the earnings are being generated by 7 names.
That's right. But there's also a problem there, right? And I mean, you pointed out exactly there. I mean, and to continue your analogy, if 35 if 35% of the home sizes and home values in an area are owned by 7 people, but they're only making 25% of the income, there's probably a problem there.
Yeah.
Right?
Yeah, it's a big problem.
In an ideal world, I mean, and again, because they're so large, that 10-ish% discrepancy is a gigantic number, right?
Yeah, it's trillions.
Trillions.
Yeah, exactly. Yeah. Well, and you're right. Like, as far as that discrepancy, from my perspective, the market is essentially priced toward those companies, which is a growthy approach to it. And you read all the things, listeners, if you're reading about, all this CapEx spend that's happening in the Mag 7, and, if any of the, and their contribution through that CapEx to GDP, if any of that stops, we have a major problem on our hands, right? So I took it a step further, and I'm about to blow your mind on this one. This is wild. So I just went to the infotech sector.
Okay.
So of the S&P, take it down to just the infotech. So those 7 stocks represent 10% of that sector. Okay. Just names, not market cap. So they're just 10% of the total names in infotech. But basically, there's 70 names in infotech, and there's 7 of them.
Okay.
Make sense? Of the earnings of infotech, they are 67%. So they are contributing 2/3 of the earnings, and they are 10% of the names. Whoa.
I mean, it's a perpetuation of the same issue.
Yeah.
Right. I mean,
and we've talked at length. Like, I mean, again, this is a situation where there's a whole lot of contributing factors to this: ETF flows, passive flows, 401k investing, the big get bigger, technology, CapEx, all the things that we've talked about at length. And so I'm not saying anything other than this is a staggering concentration that's occurred. And it will be fascinating as we enter into 2026, what happens to those names.
Well, and I think, again, just to lay it out very simply, the bottom line is that at some point there has to be a reconciliation of that discrepancy. And what that either means is that income rises to the size that they have grown to, or the size comes down closer to income. I don't know how else to simplify it.
Yeah, in a perfectly efficient market.
In a perfectly efficient market.
I mean, in a perfectly efficient market, Judson, you were dead on. The earnings would follow the fair market value. That's just the way it would be. I mean, our market's not perfectly efficient in every way. There are pricing discrepancies, which is why people trade stocks. But you're exactly right. I mean, obviously, if the fair market value is 20% and they represented 30% of the earnings, there's a buying opportunity there, right?
That's
in
right.
this case, it's the opposite. So it'll be fascinating to see. The thing that I think, the other news in the market that dropped since we recorded last, that I think is particularly fascinating for a whole lot of reasons, is my prediction from 2023. No, 2024 is finally coming true. Elon Musk has confirmed that SpaceX will be IPOing. In all likelihood, it'll be the largest IPO in the history of the market. Just staggering numbers, and I'm sure it will be it will be one of my favorite days on X maybe ever, when this all happens. So if this does in fact IPO, number one, can't wait just to see what happens to it, because the future of that company obviously is incredibly bright. Number two, what happens to the fund flows as that IPOs to these Mag 7? Listeners, we are currently like shrugging our shoulders. I don't know.
It'll be a new test.
Right. Exactly. And I mean, that's just the beginning of the future, because like these 7 names, are perceived as the future of the U.S. economy. You start getting some of these other companies in that are leveling things up even more. Get your popcorn ready.
Well, and what this really goes back to is that you can count on our predictions are correct 100% of the time.
Always.
Yeah.
It just takes a couple years.
It just takes a while.
I just said that I was excited for it, and it's only going to be 2.5 years late. So,
yeah,
but I'm excited for it. Well, folks, as always, interesting 26 year. We are in all likelihood going to have at least one cut next year, but lots to look forward to. We'll do a full, as I've mentioned several times, we'll do a full market recap for the year as we head into the end of close here with Brad Sanders. So stay tuned for that one as we turn the calendar to 26.
Yeah, come join us. Keep joining us in 2026, where you'll get, like Hunter's been talking about, the full market recap. We'll also be doing our annual predictions, which will be exciting.
We're going to be right, by the way.
Clearly. So yeah, if you want to keep up with this, the best way to do that is to hit subscribe so you never have to miss an episode, and you can always go back and catch up on the ones you missed. Hey, listeners, quick heart to heart here. It's been about 6 months since someone left us a review on Apple Podcast, and honestly, I'm starting to feel like I'm on the naughty list. So if you're enjoying the show, we'd really appreciate you taking a minute to leave us a review. It helps more people find the podcast, and it's basically all I want for Christmas this year. Well, that and the Goonies commemorative Lego set, which, if you're feeling generous, can be shipped to 17 Cowboys Way, Suite 300, Frisco, Texas. But let's be clear, the review is free. If you have a question, comment, or even an idea for a future episode, reach out to kamewaters.com/wealth. We read them, and yes, we do love replying. And if you want to learn more about what we do and we're not behind the mic, visit kamewaters.com, where we're helping more than 3,400 clients work towards their long-term financial goals. Thanks for listening to the Accumulating Wealth podcast. We'll see you next time.